In my hunt to analyze exceptionally high-yielding investments, the majority of what I come across is often too good to be true. It's not uncommon to come across a stock that yields over 15%, but after looking at its share price performance and dividend history, we can see that both have deteriorated as time goes on. But one dividend investment has offered an exceptionally rare combination. Despite launching a little over 2 months ago, its share price is already up 16% as of the making of this video. Plus, its dividend yield is an eye-popping 49.71%. The fund we're going to take a look at today is the YieldMax NVDA Option Income Strategy ETF, which is ticker symbol NVDY. It's an actively managed fund that seeks to generate monthly income by selling synthetic call options on Nvidia stock. NVDY pursues a strategy that aims to harvest compelling yields while retaining cap participation in the price gains of NVDA. The fund employs its investment strategy regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take defensive positions during each period. On this fund's website, it says that NVDY currently offers a distribution yield of 49.71%, which makes this one of the highest yielding investments out there. Despite this ETF only existing for 2 months, it's already been performing exceptionally well. Since May 10th, NVDY's share price has grown by almost 17%. Additionally, this ETF's last dividend distribution was for 95.47 cents per share. That means that a $10,000 investment in this ETF at its current share price would have paid you a monthly dividend of $41.16. Comparing NVDY to the S&P 500, we can see it's done nearly twice as good as the market. Since inception, this ETF has provided a return of 22.32% compared to SPY's 10.13%. A $10,000 investment in NVDY 2 months ago would now leave you with $12,232. This is assuming that dividends were reinvested back into buying more shares of this ETF. So with so much potential, let's take a deep look into this fund to see if it's a worthwhile investment. Starting with this fund's objective, it says the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of common stock of Nvidia Corporation, subject to a limit on potential investment gains. This means this ETF pursues a single investing strategy, which is selling options on Nvidia Corporation stock. In some ways, it's a little similar to a lot of other covered call funds that exist, like QYLD, which is the Global X Nasdaq 100 covered call ETF. This ETF writes covered calls on the Nasdaq 100 index and passes the option premiums on to shareholders in the form of dividends. Another covered call fund is SPYI, which consists of a mix of written call options and long call options on the S&P 500 index. But what makes NVDY different is that it writes call options on only one holding, which is Nvidia. Nvidia is a technology company that provides graphics and computing and networking solutions. They also produce artificial intelligence hardware and software products. Having been founded back in 1993, this company now has a market cap of roughly $1.17 billion. The company behind this ETF, YieldMax, has several other ETFs that follow a similar strategy. Their other funds include OARK, which writes covered calls on Cathie Wood's ARK ETF, TSLY, which writes call options on Tesla, and APLY, which does the same thing on Apple. I made a video about TSLY back in April, which is currently offering a yield of over 70% according to their website. But this company has a whole bunch of other covered call funds planned, including one for Facebook, Amazon, and Berkshire Hathaway. With their first ETFs being launched in late 2022, we haven't seen much of a track record in terms of this management team's performance. But NVDY and YieldMax's other funds use covered calls a little differently. If you recall in this fund's description, it says that it follows a synthetic covered call strategy. This fund's prospectus clarifies what the difference is, which is that a traditional covered call uses a strategy where the fund sells a call option on an underlying security that it owns. But with a synthetic covered call strategy, the fund doesn't actually own the underlying security, but rather seeks to synthetically replicate 100% of the price movements of the underlying security through the use of various investment instruments. If you want more information on how the process works, you can read the prospectus on their website, but NVDY doesn't actually own shares of Nvidia, and you're not a shareholder of Nvidia by owning NVDY. With that being said, it's important to keep in mind that NVDY's movements mirrors the movements of Nvidia stock. When the share price of Nvidia falls, then NVDY falls in a similar amount. But when the share price of Nvidia rises, then NVDY rises to a certain degree. Just like with other covered call funds, the amount of upside in share price you'll experience is going to be limited, but you'll still feel the full force of share price declines. Because other covered call funds invest in either a large group of stocks or an entire index, this makes them more diversified and thus safer. But with NVDY, you're placing all of your money on one company. Let's take a closer look at the dividend this ETF pays. You can see that although NVDY has only declared 2 dividends so far, the amount has differed by quite a bit. The first dividend it paid was for about 74 cents per share back in June. In July, this ETF declared a monthly dividend of about 95 cents per share. So let's instead look at TSLY's dividend performance since it follows a very similar covered call strategy and it's been around much longer. TSLY's dividend kept trending downward for months, but then it started going back up again within the last 2 months. I decided to compare the dividends to the share price of this ETF, and I saw that there is a noticeable trend with the dividend. If you look at TSLY's share price, you can see it dropped quite a bit before it actually started paying a dividend. The first declared dividend was for about $1 per share, followed by about 90 cents the next month. The next dividend was also for about 90 cents, and then you can see that there was a drop in share price. The next month's dividend was also lowered then to 82 cents per share, then the share price fell by a very large amount. The next month's dividend was dropped all the way down to 44 cents. But then starting in May of this year, this ETF saw a very strong rally, and you can see that it really benefited its dividend. It went from 44 cents to 80 cents the next month, and then $1.06 the next month as this rally's continued. With this in mind, we can see that there is a correlation between the share price and the amount of the dividend. When the share price rises, then the dividend payout rises, and when the share price falls, then the distribution falls. Even though this is for TSLY, the exact same thing is going to happen to NVDY. So now that we know how this fund works and what to expect of it in terms of its share price performance and dividend amounts, is this ETF a worthwhile investment? As I said with TSLY, your opinion on this ETF should completely depend on your own personal opinion on Nvidia. Nvidia stock has seen a huge rally this year, with their share price growing by over 217% this year, which is pretty insane. To give you a good idea of just how much it's jumped up recently, let's look at the overall performance of their stock since their IPO. Check out the massive jump this stock has done in the last 7 months. The reason for this rally, in my opinion, probably has to do with all the hype surrounding ChatGPT and all the other artificial intelligence platforms. News outlets have been reporting on the craze surrounding ChatGPT and the other AI platforms, which directly benefits Nvidia. Because this company creates the hardware that these AI platforms use, there's been a significant amount of hype for this stock. With that in mind, it's my opinion that Nvidia stock is significantly overvalued right now. When the share price does go back down, then NVDY is probably going to fall pretty hard, both in share price and dividend distributions. If NVDA falls to the share price it was back in late 2022, then this YieldMax ETF is probably going to get destroyed. With that being said, if you think this extreme rally is going to continue for Nvidia, then it would make sense to consider this investment. But because I think Nvidia is in a bubble, I think this ETF is basically a ticking time bomb. It's impossible to know just how much longer this rally is going to continue, but once it does fall, then NVDY is something that I want to steer clear away from. That's not to say I don't think the other YieldMax ETFs are all bad, it's just that the underlying security this fund uses synthetic call options on is experiencing a huge bubble. Like I said though, it's up to you if you're a believer in the continuation of this stock's rally, but I'm not planning on touching it. And with that being said, that's going to wrap up our look today at YieldMax's NVDA Option Income Strategy ETF. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.